Thank you for joining the webinar today, where Stuart, our CEO and Chairman at Acuity, and Alex, a financial planner in our financial advisory team, will be addressing the question, are you prepared for the economic roller coaster and the impact on your investments?
Great, thank you, Rosie. Well, welcome back, everybody. Acuity Professional, we are a professional services firm, and part of what we do includes the wealth management investment advisory piece. And I'm delighted to have Alex join us, one of our highly qualified investment specialists. And we're going to have a real focus 20, 30 minutes look at where are we and what can we do about the future. We'll get some of the hygiene stuff out of the way in terms of what we need to do. Obviously, we're in a regulated environment, so Acuity Professional Advisors is regulated by the Financial Conduct Authority. And today, we're just going to have a look at three key areas: what's happening in the marketplace and the outlook, your risk and your loss appetite and asset allocation, and strategies to protect and preserve your wealth. Obviously, standard disclaimers, investments go up and down. We're going to be giving you a historic perspective and a generic forward look at ranges of possibilities. What we're going to be discussing today is not tailored for your personal situation, but it's information which can help hopefully inform your thinking and decision making. And we are absolutely here at your disposal to pick up any points following this briefing, and subsequently we have a team that can really bespoke something that's relevant for you. Okay, so wow, what a time we're living in, huh? Wild times. I've read that in the Financial Times just a couple of days ago, and I thought, you don't often hear the Financial Times state what wild times we're living in, but we are. And of course, the only thing that is certain is the future is completely uncertain at the moment. Who would have thought 6 months ago we'd be here? And I'm completely certain that this is an uncertain time. So let's embrace that. But then, of course, let's be mindful of what we need to do. So we've got to be expecting market volatility and surprises. We have Wirecard. We're going to find all sorts of issues that are going to come out in the marketplace. The market never ceases to surprise us. So let's be prepared for this roller coaster and not be shocked and horrified. And that's the reason I want to do this webinar today, is to say we're at an okay point at the moment. We've recovered a lot from where we were, but we need to be really, really positive looking forward at what we're going to be doing. So you've read in the press, is this a recession? Is it a depression? Are we talking about, is it a V? Are we going to bounce back? Is it a W with a second spike? Is it a U? Or is it an L in terms of a depression? The answer is no one knows. What we do know is we will discover it over the next 6 months, a year, 18 months, 2 years, 5 years. We are in an unprecedented time in terms of the scale of the global debt. We're not talking billions anymore, we're talking trillions. And I avoided putting lots of numbers on here because it's just, you can't really relate to some of these commas and zeros. But it is a scale which dwarfs even the 1930s. So getting real about that and recognizing the debt crisis and the corporate capacity to make interest and capital payments, our damage, we all feel reluctant at the moment to, we all really do sense there's a chill in the marketplace. And of course, we can't really forecast accurately where it's going. What we do know is it's having an impact. It's had an impact on the property market. There's a real risk that this, if you're investing in commercial property, this could become a negative asset class. And we're finding that as a professional firm, we've got to give certain undertakings to even our insurers about the type of advice in asset classes we'll give. And they picked on this, surprisingly enough. So we're going to see a market roller coaster. We've seen in the last few months this negative 35–40% up to a NASDAQ composite high. I mean, talk about a roller coaster from the depths to the peaks. You may have come across this sort of term, FOMO seems to be a driver, the fear of missing out. People are hanging around thinking that if they get out, they're going to miss out. And we don't want to be part of the social herd when it comes to investment thinking and protecting our wealth. So there is a very real possibility of severe market ruptures. You know, we read every day about the geopolitical tensions, US, China, of course, on our own doorstep, Brexit. You know, we passed the June 30th deadline for agreeing equivalent terms. We didn't. So it looks like we could be increasingly heading to a no deal or a very limited deal Brexit. Obviously, there's a lot of talk around a second spike and 120,000 possible deaths. And of course, all this could change in an instant with a vaccine. We're making great progress on vaccines. And we've got some of the greatest minds in the world trying to solve this problem. And, you know, if that happens, then it's a whole nother variable to factor in. Facts are we have seen the UK shrink by 25%. And the OBI is saying that we're looking at the worst economic slump for 300 years. The Fed are saying it's a long path to recovery. You know, we've got unprecedented unemployment in the US, 18 million versus a 5.6 million previous period. In the UK, we've got 9.4 million people being paid to sit at home. That impacts 1.1 million companies. So it's far-reaching, unprecedented, eye-watering. The eye-watering aspects of the debt, the UK government, 412 billion in debt. We're going to have a deficit of 300 billion. To give you some context, that's 15% of our national income. And it's 50% higher than the Great Recession in 2008. That's the scale of what we're talking about. So a lot of things for us to be mindful of. We shouldn't be paranoid. We shouldn't be frightened, but we need to pay urgent attention. And that's why we're really keen to engage with you. We're going to see big unemployment. We're going to see short, medium, long-term effect of this scale of global debt. For the first time ever, I used to watch movies and watch the movies about the zombies and things. I never thought I'd see in the FT about zombie companies. And, you know, with PEs, historic PEs are 17, and we're now looking at price earnings ratios of 22. You know, that is flying in the face of economic fundamentals. And people talking about a uncoupling from market fundamentals to market value. Well, yeah, but there has to be some substance. A lot of pressure on companies to cut dividends. That's going to impact a lot of the fund managers and fund houses that you may be using, the ones that had a value style. They're really hurting at the moment and will hurt. So really important for us to be mindful of asking the right questions. And Alex is going to pick up some of those questions later. But the property, you know, in terms of key issues, the property impact with the stock collapse of the market and the Chancellor's recent initiatives to try and kickstart that with the stamp duty is well received, but it's going to be one of many measures. Mortgages are down, a 90% fall, and that's a third of the 2008 trough. So, you know, let's not be deluded in the markets, you know, recovered, and listening to all the investment houses who have a self-interest to tell us it's all okay. Let's look at the reality. Well, UK PLC, global PLC, huge rush to get liquidity, 5.4 trillion raised over the 3-4 months and since January to shore up their balance sheets with cash. That's a record debt level. Retail savings, a lot of people are sitting on their cash now. You know, we've had 57 billion in 3 months in the UK going into the savings space. We're seeing a change of mindset from enforced to a cautionary mindset of we don't know what's happening. What we do know is we're going to need some cash to get through. Credits down by 4.6 billion. You know, it's a very much changeful marketplace. Sectors impacted: energy, air transport, commercial. all these areas that you're familiar with. And we know in the ease down that there's it's going to be, as the Fed said, it's going to be a long path back to recovery. Let's not kid ourselves. I think everyone who's relatively sane will know we're not just going to bounce back to where we were. In the onset, we thought maybe that was probable, but this sustained global lockdown and all the anxiety will have ripple, if not potentially tsunami effects. So what about the next quarter, July to September? Really important for us to be mindful over this next period. The corporate capacity for the companies that you may hold in your equity portfolios, UK and international. What's the capacity for them to make interest and capital repayments? What's the default risks, etc. We've got to be really mindful of this, but not be paranoid. The truth is, we will pass through this. The truth is, it will become economic history. And the truth is, if we're mindful and we're proactive, then it's not. It's going to be a very challenging time, but it's not the end of life as we know it. It's certainly life very different as we know it. So, key things for us to do is we would really encourage you to think about your asset allocation. Your asset allocation needs to evolve. It needs to change. What it's been is not how it maybe needs to be. The asset allocation needs to tie in with your attitude to risk. A lot of us invest in collectives, and those collectives will have certain appetites. Disposures 20% to equities, 40% to equities, 60% to equities, 80% to equities. Varying proportions in property, UK property, international property, and of course some exposure to alternative asset classes. And what we really need to think about, and we would encourage you to think about, and we're really happy and very much open to having these discussions with you. Think around the geographic exposure, not just the UK and the US, but also the emerging markets. People are saying, well, let's get to the emerging markets. Well, actually, let's think about that. Let's really, have some considered thought, and let's bounce around those areas of exposures. Then I think another key thing is look at your fund manager, look at the asset house that you're with. What are the underlying holding ratios in terms of the asset classes that they're holding? What's their view on the market? How are they tilting the portfolios or adjusting the portfolios? Now is a good opportunity because the market has had a degree of bounce back, and now is a good time to batten down the hatches and be very confident that your asset allocation and your portfolio reflects your risk and your appetite and your capacity for loss. Well, let me use that word. We all hope it's going to be gain, but let's plan for the worst, and then tactically adjust as we have the facts to merit that, which is quite key. US stock futures are rallying. We're getting all sorts of market indicators that good times are back, maybe, but the reality is we know that can't be the case. So we have to take a mindful perspective. So really look at your asset classes. It's not complicated. Let's look at non-correlated assets. You may have picked up in the news people talking about gold and cryptocurrencies. Well, maybe you should have 1 to 3%, or whatever your appetite is. Think about it. Gold is at a high at the moment from the 1970s. It's an asset class that a lot of people don't think about because it's unproductive. But as a safe haven store, it could be valuable. Same as silver and other scenarios. But once again, it's all part of a diversified strategy that we need to have. And of course, cryptocurrencies, for those that are a little bit more ambitious or a little bit more understanding in that space, is another thing that can be thought about. One of the things that we look at, and we're really wanting all our clients to be aware of, is the equity sector is clearly, the equity marketplace is where we want to be long term. And so this type of stocks we want to be in. We want to be in the meat and what Ray Dalio calls the meat and potato stocks, and there are certain things that we're always going to need to buy and consume and need and want. And they're the spaces that we need to be in. And some of the other sectors that are being adversely impacted, we probably need to be reconsidering our positions in. We definitely want to be in the tech type spaces with the innovators because life is changing. I put this slide here. This is straight out of the FT. The S&P 500 becomes the S&P 5. Look, Amazon, Microsoft, Facebook, Alphabet, Apple. 25% of the value of the S&P 500. Who would have thought such a density of value in only 5 stocks? Well, we do live in interesting times. So we want to be in the right areas. No one knows the future. We certainly don't, but we know the general direction of travel. There is going to be a very exciting times ahead once we come through these deep valleys with significant shadows. The shadow of the global borrowing and the commitments of the central banks to fund our way out of this, is legendary. It is. It's actually going to be legend. It's going to be in history books as things that people read about. Wow, look at that. But there are consequences of that. If the economy, the chancellor on the other hand is going to have to get that money back, and it's not going to be coming back in a rapid period of time. So we're going to be in quite a long path of, maybe austerity, maybe. Who knows what depression looks like these days. It certainly isn't like the 1930s. But we're going to be in a period of significant change. So these are things that we'd like you to get, we'd like to tell you first or brief you on and say, please think about this. I've thought about it, my own situation, my family situation. And it's things that when we're talking to our clients, you're effectively part of our corporate family. We want you to be mindful of taking literally, excuse the pun, taking stock and making the amendments, if there are any. You may be very happy, you've got a 20, 30, 40, 50 year view, and you're like, I'm really happy with where I am. That's fine. At least it's been a conscious and deliberate decision, in which case then we can turn off the economic anxieties of the roller coaster and enjoy watching everybody else's faces as it goes up and down as we feel relaxed. But as we know, life is not really an observer sport. We all are on the roller coaster together. So let's have a think about that. So remember the golden rule of investing. I've added to this since my first market update. The golden rule of investing is there's only one rule, and that is to buy low. I've added to this and said, it's not only to buy low, it's to not sell low. Let's not be in the roller coaster of having to sell, and the roller coaster is along the bottom for a sustained period of time, and you need to realize some capital, but you're realizing it at the wrong time, at the wrong place. So, the need to plan in an uncertain time is really key. We need to, I really would encourage us all to rethink and be prepared. It's like the Scouts motto, isn't it? We always be prepared. And we don't need to be a particular futurologist to know things are changing all around us. Think through your resilience and risk. Be happy with it. Get to a place of contentment that you're content with, that your asset allocation is correct. And then, hopefully with our help or your existing advisor's help, look at making sure that's worked out and assess your capacity for loss and time to recover. Take a 1 year, 3 year, 5 year, 10-year view. And, we don't know where the market's going. It looks like the market's going to keep on keeping on, but the economic facts are at some point this is going to catch up. The bubble will burst. So review your asset allocation. Does your risk and asset allocation choices really match? And it's not complicated, but please, I often talk to my team about the Chinese proverb of there are 5 frogs on a log, and 3 decide to jump off. And the question is, how many frogs are on the log? And the answer is not 2. The answer is actually 5. And the reason there are still 5 frogs on the log is because there's a difference between decision and action. And my message to all of us today is, let's just take some action on either confirming, reviewing, or changing where you are in light of possibilities, unpredictable, uncertain possibilities of the future. Hope you found that useful. I'm going to hand over to Alex shortly, but just want to finish on this one slide that, there are investment and market worries, but please remember you're not alone. You can access us. We don't have perfect vision, but we have strategies and tactics which could be really useful to you at this moment in time, and certainly as we go forward. And together, we can certainly find some of the answers, and we will journey through this. Alex, over to you.
Hi everyone, how's everyone doing? Thank you, Stuart, that was fantastic. So really, I think the message here is, when we look at your funds, especially in such volatile times, this word volatility can seem quite scary as markets go up and down and there's a lot of uncertainty. However, volatility is not always a bad thing, because volatility often means that there are positions out there that a skilled fund manager will identify and they can make some fantastic returns off the back of those. However, we also have to look at the downside of volatility, and we have to look at risk, and risk is absolutely key. So I just wanted to talk to you just for a few minutes about what it is that we look for when we choose a fund that will benefit your particular needs. Now, I've got a couple of points here. So as we've already covered, strategic asset allocation, or where we put your money, whether it's in UK equities, whether it's in UK bonds, American bonds, property, whatever it may be, this leads to better diversification. And diversification, it keeps that volatility under control. Now, we also look for the most tax efficient funds because no one likes paying tax. We also make sure that your funds are rebalanced. Now, this is where funds, as we buy different assets, different stocks or different bonds, they will eventually start to stray slightly depending on their specific risk from the overarching risk or the overarching volatility that we're looking for. So we always look for funds that are constantly being managed and they're constantly being rebalanced. Now, this could either be in an active environment or a passive environment. I won't go too much into detail on those two because that's a whole other topic for possibly another time. And a lot of this comes down to the skill of the fund manager. So as Stuart was already saying, we really do our due diligence on the actual fund manager themselves. You know, what is their experience? How old are they? What sort of economic crises or situations have they lived through in their time? And what have they done in the past when they faced those situations? We also make sure that these fund managers are acting in a proactive manner. So they're forward looking. They're not sort of letting crisis unfold and then trying to mop up afterwards. And you can see this in the historic data of how fund managers have managed these crises in the past. And we also make sure that they're governed. So it's not just the fund manager who looks after a fund. They have an entire investment committee. And we've got to make sure that that investment committee absolutely are working within their risk mandates and making sure that they're keeping these volatility ratings within what they said they were going to do. Now, this is obviously a lot of information for everyone. But the real message that we want everyone to take home here is it is absolutely vital, if you have pensions that you are planning to live off in the later part of your life, or you have investments, perhaps you want to pass those down to grandchildren or children, it is absolutely vital that during these really uncertain times, we absolutely look at making sure that your funds are right for you and making sure that the risk is right for you and that you're not taking too much risk, or in some cases, taking too little risk. So I hope this has helped, and I'm really happy to sit with anyone and really have a deep dive into collective investments, multi-asset portfolios, whatever it may be, and really help sort of educate people into being able to understand this stuff themselves, and also sitting and reviewing these things with everyone. Honestly, it is so important at the moment.
Excellent. Thank you, Alex. So, Stuart, I'll hand back over to you in a moment to close off the webinar today. But after the webinar, you will get this afternoon the recording and the presentation slides. You can have another look through. And as I said at the start, you will also have a link. And if you would like to book in a free, no obligation consultation with Alex, who can talk you through further what has been covered today, then please do take up that opportunity, because as they've both said, now is really the time to take some action. So back over to you, Stuart.
Yeah, so we do have a very experienced advisory team. Alex is representing those today, but some of you may already be looked after by some of our other advisors, chartered financial planners. So we do have the team here that are available to help. Although we're working from home still, we are fully available to jump on a Zoom call or a Skype call with you, and we've been doing that very successfully over the last 3 months. But just words of encouragement: be of good cheer. We will pass through this together. It is going to be a very challenging time. No one can doubt that. And but what I would just say is, please make the decision and take action to review where you are, review your position, and make sure you're best placed to ride this through. Ride it through, we will. That's inevitable. But let's ride it through well. And there will be things that come up which nobody has seen. No one saw COVID. I mean, it's pretty much the reality. But thanks for listening. Keep an eye out for other things that we're going to do. We're very keen to use this time to, ensure all our clients gain more and more understanding of the financial arena and make some really good decisions. And in the future, we're going to be doing a whole range of additional things, inviting fund managers and others on to talk to our clients. They do these themselves, but we think it's more appropriate to use our own forum for our clients to engage proactively together. But thanks for your time. Really appreciate you checking in. And if you want to watch this again, it'll be available. Thanks to Rosie. Big thanks to Alex. And we look forward to journeying the next leg with you. Thanks very much.